The biggest problem I see with high-income wage earners is how you are limited with tax deductions, which causes you, as the taxpayer, to pay more in taxes year after year. The more you earn, the more you pay Uncle Sam. This is why a lot of high-income wage earners fear making more money, because you, as the taxpayer, feel there is no way to avoid paying more taxes legally. So here is my question to you. What would you do? You just got your W-2 and you realize you paid a little over $300,000 in wages and you paid a little over $90,000 in federal taxes, not to mention the state taxes you paid. If you do not know the answer to this question, then you are in the right place. I will show you how to leverage buy and hold real estate as a high-income wage earner, as well as showing you the importance of depreciation, cost segregation, and my favorite, bonus depreciation. So let's get into it. As a taxpayer, you first have to understand how you're taxed as a wage earner. This is the first important piece to understand so that we can lower your taxable income. You have two buckets when it comes to taxes. You have your non-passive income and you have your passive income. The non-passive income consists of income from work that you are actually doing. This consists of income like your wages, as well as your 1099 income, stock, and crypto income. This income is subject to federal, state, Social Security, and Medicare taxes. You, as the wage earner, fall under the non-passive income category. Next, we have the passive income bucket. This is income you receive from work that you are not doing, like rental real estate or businesses that you do not materially participate. So what does material participation mean? Well, material participation means that if you are involved in the operations of the business on a regular, continuous, and substantial basis, then you materially participate. Now let's rewind just a little bit and go back to non-passive income and passive income. So in order for us to understand the importance of non-passive income and passive income, we first have to understand the two kinds of passive activities. The first one is rental real estate, and the second passive activity is businesses in which you do not materially participate, meaning you do not typically work in. So the question is, how do we get you as a taxpayer that's a high income wage earner into the passive income bucket? Well, the answer is quite simple. It's by leveraging buy and hold real estate. This allows you to use a tax strategy that most people think is only for the wealthy, and it's called bonus depreciation. When you purchase rental real estate that you buy and hold, you are then able to depreciate that asset over 27 and a half years if it's residential or 39 years if it's commercial property. So what is depreciation? Depreciation allows you to recover some of the cost of that particular property over a certain period of years. For example, if you purchase a rental property for $500,000 and the building is valued at $300,000 and the land is valued at $200,000, we know that you cannot depreciate the land, but we can depreciate the building. So we're going to do that over 27 and a half years. So if the building is valued at $300,000 and we depreciate it over 27 and a half years, that's a $10,909 deduction every single year for 27 and a half years. This is a typical way you would depreciate residential rental property. Now, if you like this example, let me show you how we can speed up the process and save you more time and money on your taxes. So how are we going to do this? We're going to do this by cost segregation. Cost segregation is a tax strategy that allows you to reclassify certain components of your rental property to accelerate or speed up depreciation by 5, 7, or 15 years instead of 27 and a half years or 39 years. For example, the building's value is $300,000. But inside of the building, you have components like your stove, refrigerator, appliances, and other fixtures that's valued at $150,000. If you depreciate this over the course of 27 and a half years, you will be able to write off $5,454. Now, if you get what we call a cost segregation study, you'll be able to take that $150,000 for those components and depreciate it over 5 years, giving you a $30,000 tax deduction each year for 5 years. It is important to remember that these components typically last 5, 7, or 15 years, which is the reason why we want to depreciate them now rather than waiting 27 and a half years or 39 years. Now let's dive into my favorite part of the tax code, bonus depreciation. Bonus depreciation allows you as the taxpayer to deduct a larger portion of the cost of the property in 1 year. So instead of waiting 5, 7, or 15 years, we're going to deduct a larger amount of depreciation in year 1. According to the section 168 of the Internal Revenue Code, this is qualified property with the useful life of 20 years or less. So instead of depreciating components like your stove, refrigerator, furniture, or fixtures over 5, 7, or 15 years, you can now do it over the course of 1 year. The cost segregation study is what identified the components in the rental property and their useful life that is eligible for bonus depreciation. So for example, these components like your refrigerator, your stove, appliances, furniture, or fixtures that is valued at $150,000, we can now depreciate 80% of it in year 1, and that gives us $120,000 tax deduction in year 1. It is important to know that the government is phasing out bonus depreciation every year by 20% until it is completely phased out. So if you decide to depreciate your rental property the traditional way, you will save roughly $10,000 each year for 27 and a half years. If you decide to do a cost segregation study and depreciate it over the course of 5 years, you will save $30,000 each year for 5 years. If you decide to use bonus depreciation, this saves you $120,000 for 1 year. This reduces your taxable income, therefore saving you more money on taxes. So let's assume your income is $150,000 after your tax credits and your tax deductions. Well, you now have access to bonus depreciation of $120,000. Therefore, reducing your taxable income from $150,000 to $30,000. For simplicity purposes, let's assume your tax rate is 20%. So $30,000 times 20% is $6,000 because you decided to use bonus depreciation to reduce your tax liability from $90,000 to $6,000. It saved you more money on taxes. This is why I love utilizing this strategy for my real estate clients. If you like this video, comment, like, and subscribe, and tell me what you think. Do you think this strategy can work for you? If you want to learn more about real estate, click the link above. From Everlife Accounting Group, my name is Karina, and thank you for tuning in to another episode of Financial Sense.